All right, good evening. Welcome to yet another Smartkarma weekly forum. We'll just give a couple of minutes for attendees to stream in. And while that's happening, I'm going to run us over our customary disclaimer. First off, the forum is strictly for our subscribers. It's meant purely for informational purposes. It does not constitute investment advice. It's the opinion not of Smartkarma, but that of our insight providers. And lastly, Chatham House rule applies. So please do not share any of this information on social media without express permission or for that matter, any other public forum. And with that, I'm going to take a couple of minutes to go over some of the ideas we looked at in our previous forums. I think this gives a very good sense and context on how we are progressing, the breadth and variety of different ideas we look at, and also sort of how we segment out the forum. So last week, we explored Sinotrans. This is a neat little freight forwarding and logistics company in China. Well, I should probably take the word little out because they happen to be one of the largest logistics companies, but it's really been neglected by the market. The profit in the first quarter grew 3x year on year. It's still on 5 times PE. It's got multiple catalysts. Then in our large cap section, we explored 2 stocks, not one. We looked at Xiaomi, which is Hong Kong listed, and we looked at Tencent Music, which is listed in the US. It's a Chinese ADR. And we discussed how both of these names might be back in the game after having had very good pullbacks and some interesting changes in fundamental outlook. And then in our thematic section, we spent a little bit of time understanding the carbon markets, which is a whole new space for all of us to be looking at a lot closely. And also, the pricing dynamic in this market has been very exciting. The week prior, we looked at StarHub. This is one of the telcos listed here in Singapore. We examined why it's a very compelling reopening play. Of course, markets don't typically associate telcos with economic recovery, but in the case of StarHub, that seems to be the case. Then we looked at fast retailing in Japan. This is the company that owns the Uniqlo brand. And lastly, we looked at Coinbase's direct listing, which actually got listed in the market yesterday. I hope some of you guys have been involved in that company. And so on. Every week, we try and segment the conversation around 3 themes. The first is always a small cap. The second is a large cap. And typically in the third, we look at a thematic or the way people are positioned or, the start of a new market, but something sort of on those types of topics. So this week, we're going to explore hospitals. We're going to look at one of the top hospital chains in Southeast Asia, which is trading at half the price of peers, or even less, to be honest. And then we will look at Grab. As you guys know, it's pending a mammoth SPAC listing, about $40 billion of market cap. And then lastly, in our thematic section, we will explore a Chinese ADRs post the recent blow-off of Archegos, a big family office. Let's kick things off. And just a little reminder that the forum is meant to be interactive, so please do chime in with your questions at any point of time. You can use the Q&A button or the chat on your Zoom applications. Okay, so the hospital chain that we will explore today is called Siloam International, and the ticker for that is SILO. This is an Indonesian company with a market cap just under $1 billion, 760 million to be precise. And this is, as you can see, this is a stock that fell a lot even before COVID. So early in 2018, 2019, this thing was at about 2,000 rupiah. It's recovered a little bit to 6,000, but it remains extremely cheap. So just a little bit of a thesis on this. So Siloam is Indonesia's leading hospital operator. They own and operate 39 hospitals in the country across 25 cities. It is part of the Lipo Group. Now, for those of you who attended the session on First REIT, you remember First REIT is also part of the Lipo Group. So, and First REIT, in fact, owns rights to the properties of 11 of these hospitals. Now, this company turned a corner in late 2020. They saw a small uptick in revenue, just about 5%, but EBITDA went up 37%, margins improved from 16 to 21%. That led to enormous profit growth, nearly 400% growth in profits, as well as 700% growth in free cash flow. Now, those are all great, but to be honest, until they are shared with minority investors like you and I, it's not good enough. So what we really liked is that the company also declared a special dividend on top of the already 45% dividend payout ratio. So all in, they ended up paying 181% of earnings, which was great. They've also successfully negotiated the rental agreement for 11 of the hospitals with First REIT, which means that its cost structure looks a lot better going forward. And as I mentioned, from a valuation perspective, this is on 6 times EBITDA. Its own 5-year average is 12 times. Another close hospital peer in Indonesia called Mitra Keluarga is 25 times. So look at that comparison, 6 times EBITDA versus 25 times for Mitra. And going forward, we're tracking 4 things very closely. We're going to look at core growth of the hospital, how they expand the network, how they expand the clinical programs, and also how they digitize some of their core offerings. So that's Siloam. I think just in the last week, as we were preparing for the forum today, the stock has started to move. And it's moving at a time when actually the stock market overall has been a little bit lukewarm. That's interesting to see. Take a look at the last 3 months. You can see that the stock has had a pop, but if you go back 5 years, we're sort of nowhere close. So healthcare in emerging markets should theoretically be a secular story, but that has certainly not translated as of yet in Siloam, and that's what's exciting now, to look at that transformation. If you've got any questions, please do ask. I'm going to continue going on with the forum, but again, stop me anytime. Okay, Grab. Now, you'll notice that we've put a funny ticker next to Grab, AGCUS. That's not going to be the ticker for Grab, but that is the ticker of the Altimeter Growth Capital vehicle, the SPAC, into which Grab will merge in a few months, by July, we think. Now, Grab has been covered very, very well on Smartkarma. We've been writing research on this company going back at least 2019, and we've followed the steady progression of this business, right? But just a few things more around the transaction. So Grab is backed by a SoftBank Vision Fund. They have just under 22% of the company. Uber has 16%, and this Uber stake has materialized because of the merger, the transaction that happened when Grab bought out Uber in Singapore. Then Didi in China has 8.7%, and then Toyota Motors is the last big stakeholder with just under 7% stake. In this SPAC listing, there will be a $4 billion committed pipe. Basically, what that means is investors are investing $4 billion as part of this listing. And out of that $4 billion, $750 million is coming from Altimeter Capital, which is a US hedge fund and the sponsor of this particular SPAC. Now, we already know who are some of the big investors in this pipe. They would include BlackRock, Morgan Stanley, Fidelity, a different arm of Fidelity called FMR, Janus, Mubadala, Naveen, Bermudalan, and Temasek. So, fairly solid investors have come into it. And also quite unique here, Altimeter has actually committed to a 3-year lockup period for its own sponsor promote shares. Now, the other investors do not have that 3-year lockup. If their lockup period will be a lot shorter than that. The valuation of this company, and this is quite an important point, is going to be $39.6 billion. So let's call it 40. And that means this is listing at about 9.6 times EV to sales on its forecasted 2022 revenue. So almost 2 years out revenue and then 10 times. So this is this valuation multiple is definitely not for the faint-hearted. And let's take a look at a few things, right? So when we look at the key segments for Grab, the first is mobility. And mobility includes the taxi business, right? The private car hire business. Analysts who are examining the forecast for Grab feel that the mobility forecasts look reasonable, they're achievable. The second big business for Grab is food delivery. This is in fact just under 50% of their adjusted net revenue. Now, the forecast on the delivery business could be optimistic, according to analysts. The third business is financial services. This is where they have a payments business called GrabPay. In the future, they will have a digital bank. Grab, it's quite important. They have access to payment licenses in all their core markets. They have insurance licenses in 6 markets, and they have lending licenses in 5 countries. So this tells you the scale of the financial services business that they're going to build. And I think the other good thing is that the cash burn of the company, the losses that it's making has been declining since 2019. 2019 was the peak in the amount of losses, and they are trying very hard to shift to cash generation. Lastly, and this is perhaps the greatest point, is that cohort spending has done very well. So what does this mean? So if you look at the users who joined the company in, let's say, 2016, if they paid $100 to Grab in year 1, then in year 2 they paid $141, in year 3 they paid $193, and in year 4 they paid $275, and in year 5 $363. How's this happen? It's because Grab has introduced more and more services. So customers as a whole are doing more and more business through Grab, but it's also been them increasing the scale of the services. But all in all, this shows that Grab has been very successful at generating more business from existing customers. And that's generally a very, very good thing. Now, let's look at the other side of the story. And this is very important because this is the role of independent research. The banks who are going to be involved in this deal are obviously going to focus a lot on the equivalent of slide 9. Now, slide 10. So first of all, we don't have detailed financials of the company yet at all. The only thing that's been released at the moment is a flowery presentation with some forward projections, right? But look, that can evolve, that can change. Once these financials get released, I think analysts will take a look. The second is when we look at GrabPay, which is bulk of the financial services business today, its revenue declined in 2020. Now that's quite surprising because most of the online payment companies registered good growth last year during the lockdown year. Now, I think the reason here is that 30%, at least 30% of this payments business is intercompany GMV. So what we mean by that is people use their GrabPay wallet to take the taxi or to order a delivery. Both of these happening through Grab itself. Now, what happens is when COVID came and people stopped taking rides, that led to a decline in the usage of the GrabPay wallet as well. That seems to be the plausible reason according to analysts. But then what's surprising then is that the company expects payment net revenue to actually decline in FY22, even while mobility is recovering at that time. So the numbers are a little bit inexplicable in this part. The next thing is that Grab, as per its own projections, thinks that it'll make $3.3 billion of revenue in 2022. Now, even on a pre-money EV basis, that's over 9 times revenue multiple. Now, if you compare it to, let's say, DoorDash, which is, one of the best unit economics delivery businesses listed in the US. DoorDash is on 9 times EV to revenue, but DoorDash is profitable by 2022. Analysts expect about 7% EBITDA margin. However, Grab still expects to be making EBITDA losses. So, I think this is where you will see trouble. Will Grab be able to grow into the valuation at which it's currently listing? We don't know yet, but it's certainly very expensive. This is twice Uber on a forward revenue metric and not that profitable. So I think you can dig a lot deeper on Grab on our platform, and I think it'll be useful because this is the start of US investors really paying attention to Southeast Asia. First it was the listing of C Group or C Limited, and now Grab. We have now large, liquid, multi-billion-dollar growth companies that are getting listed, and it is forcing investors to pay attention to Southeast Asia. And that's kind of good because on our forums, you'll notice we regularly bring to light interesting ASEAN companies. Okay, and that brings me to the last section where we're going to look at some of the Chinese ADRs. And it's interesting, we're talking about signs of life in Chinese ADRs. So let's take a quick look at what's going on. So I think on the 24th of March, the SEC in the US, they issued certain notices around the future and the listed status of certain ADRs. An ADR, for those of you who might not know, these ADR stands for American Depository Receipt. So this is a form of a listing of a company which is an overseas company, right? Now, some of these ADRs have a dual listing. So if you look at Alibaba, it was first listed in the US, but now it's also listed in Hong Kong. So on the 24th of March, SEC issued a few notices around companies that do not have a second listing. They're only listed in America. And that caused these stocks to fall. Now, as these stocks started falling, it triggered, it triggered the margin requirements for some very large funds. And just 2 days later, on the 26th of March, a very large fund called Archegos blew up. And that blow up impacted a lot of investment banks who were prime brokers to Archegos, and they were forced to dump a lot of stock. Now, these funds obviously owned a number of companies, but the big Asian names that really got impacted included Tencent Music, which we discussed last week. It included iQIYI, VIP Shop, Baidu, and GSX. These were the bigger Asian names. And then there were a couple of US companies as well that got impacted. And that included CBS, Farfetch, and Discovery. Banks started selling blocks very quickly. Morgan Stanley and Goldman Sachs were the first guys to hit the market. After that, we saw Wells Fargo and Credit Suisse. And actually, Credit Suisse continued to sell down blocks for several days. I think even earlier this week, we had some blocks being sold down by CS. So huge selling. And these stocks dropped, 30, 40%, right? It was free fall. And these are big companies. But by the 29th, some of these stocks started to find a floor. And, the theme that we're talking about here is that some of these companies are actually pretty decent companies. And going into the 24th of March, there were a lot of people who were happy buying these stocks. But, just a few days later, you're getting these stocks on a 40% sale. And hence, from a technical standpoint, from an efficient market standpoint, it makes sense to be staying long Tencent Music, iQIYI, and VIP Shop. GSX is a very different story. We've actually covered it as an idea with potential forensic accounting issues in a previous forum. So that's a name that we would definitely stay clear of. And Baidu didn't fall that much. And in fact, Baidu now already has a dual listing in Hong Kong. So for that reason, you leave Baidu out as well. On the US stocks, our analysts don't have a strong view, and hence we haven't sort of included that for the slide. But with that, we're at the end of today's forum. Once again, I'm going to give you a chance to ask any questions, either on what was presented today or in previous sessions, any opportunities that you think we should be talking about or looking at in the coming weeks. Yeah, over to you guys. Actually, perhaps one thing that I'll bring up is we're getting a lot of questions right now about value stocks versus tech. And I think one of the things that's quite interesting now is, after these big sell-offs in tech that we saw in March, the NASDAQ has actually climbed back to heights. And these, the good quality tech names are all starting to catch attention again. So I think there's a revival of tech and growth back over a value again, at least at the start of April. Okay, a couple of questions. One is, will Baidu face regulatory issues in China like Baba? Well, Baidu, so what are these regulatory issues? I mean, there's two types of issues that Alibaba is facing. Well, the first has been around their financial technology business, their fintech business. Baidu doesn't have that, so clearly it's not going to have those issues. I think the other issues Baba is facing is around monopolistic practices. Again, Baidu has not really been active in that sort of M&A, and hence it seems very unlikely that they will have those types of issues. Okay, second question. This is a pretty good one. Are past webinars available for subscribers to watch? We do not post these sessions on our website at the moment. They're meant to be live and interactive. However, we have several subscribers write to us asking us for recordings for a particular prior webinar, and we are very, very happy to supply those. Next question. How can foreign investors tap the Indonesian market? Well, Indonesia is a fully open market to foreigners. The only problem is it's not necessarily available on all the trading platforms, but you can definitely invest in it through, I guess if you're based in Singapore or Hong Kong, you can use any of the major private banks, or you can use brokers like Philip Securities to transact in this market. And I would highly recommend looking into doing that, because this is a 200 million plus population emerging market that's firmly on the growth path. And you don't want to miss out on that growth story just because you had your account set up with someone who did not offer access to Indonesia. And the last question is that I see on this list is, have Goldman, Morgan Stanley completed the sell-offs? There was some report that a bank was still selling blocks yesterday. So it's very, very likely that Goldman and Morgan Stanley have completed the sell-offs. I think most of those happened on the 26th. Credit Suisse has still been selling down some blocks, but it's, just based on the price action itself, it seems bulk of the selling is behind us. Fantastic. So thank you very much for the questions. If there aren't any further, I'm going to say bye-bye and look forward to hearing from you next week. Thank you.